Was your small business or side hustle profitable last year? If you had to value your business, would you know how to do it, even just basically? Let's talk about that today. Welcome to The Profit Dare. I am Tim Kaiser. On this channel, we provide simple financial solutions that inspire savvy stewardship. Thank you for stopping by today. So we've been on a series talking about my book called Next Level, which is designed to help small business owners and side hustlers understand the different forms of the C-suite roles: chief executive, chief financial, chief marketing, chief operating officer, things of that nature. And today we're talking about the chief financial officer. So this is going to be a real high level overview. I'm not a CFO, but I know enough to run my business, right? So, and I do a lot of financial work in my day job as well. So let's talk about that a little bit today. So we're going to talk about the financial statements, but we're going to go even easier right now for those of you who are interested in starting a small business or a side hustle or have already done this. Number one thing, in my opinion, is that you should have a separate checking account. I know this may sound basically kindergarten, but people often commingle their personal funds with their business funds, and it's dangerous for a couple different reasons. The easiest thing is you never really know if your business is cash flow positive because you're mixing a bunch of money together, and pulling it apart is challenging. But two, if you ever have the displeasure of being audited by the IRS for your small business or side hustle, you do not want to have your personal account commingled in there and have them look at both. It's just easier to keep them separate. So I encourage you to, if you haven't done this yet, go to your bank, your credit union, take the documentation that you need to down there and get a separate account just for that and keep it separate. Do not commingle those things at all. I know it may sound like silly. Well, I am the sole proprietor. I am the person. The business is John Doe, and I am doing business as whatever. I'm telling you, you want to do this, right? So that's the first thing. Second thing is, let's talk about financial statements. So you have three financial statements. You have the balance that we're going to talk about. Three: balance sheet, income statement, also called the profit and loss statement, and the cash flow statement. The balance sheet is a snapshot. It's a moment in time what's going on in your business. So at one time, then you have the balance sheet. There is a balance sheet equation. It's this: assets equal liabilities plus equity. You can move it around. There's a mathematical law that says you can do this. You can go assets minus liabilities equal equity. It's the same thing. You get the same result, but they keep them separate for a reason. So assets are things that you own, and that be your cash. Receivables are a legitimate asset, and they're, even though they're intangible, they're legitimate. Inventory, long-term, like a building, property, plant, and equipment, things of that nature. That's your assets. Your liabilities are things that you owe, right? That'd be your accounts payable, your term loans, things of that nature. It's not like necessarily like your like a utility bill or whatever. That'd be more of an expense. But payables are in there. They're in there as well for different things. And then you have your equity. Now your equity is so the assets are things you own, liabilities are things you owe. So assets equal liabilities plus equity. Why would equity be on that side of the equation? Because the equity in the business is what the business owes you as the business owner. That's your claim against the business. And it starts with a common stock. It's your initial investment in the business. So let's say you've taken my advice. You say, I need to go down to the local bank and open my own company checking account. And let's say you have $1,000, which is a great number to start with. And so you go down there and you have personal funds of $1,000. You do all the paperwork with the banker, and you now have your own bank account. You're like, oh, I should go ahead and do a balance sheet because I've never done one before. And so then you do the balance sheet, and you have the asset is what? Cash, $1,000. Do you owe anybody anything? Not yet, you don't. So the assets are zero. But also that $1,000, you put it in personally. The business owes you that money back eventually. That's your investment in the business. So assets 1,000, liability is zero, equity, owner's equity is 1,000, or common stock, however you want to word it, is 1,000. The balance sheet balances. You'd be surprised. I've been looking at financial statements for couple decades, reviewing them for small businesses on a regular basis. I've seen thousands and thousands of different financial statements over the years. And you'd be surprised how many financial statements are submitted to a lending company, then the balance sheet doesn't balance. It's called a balance sheet for a reason. I mean, you'd be surprised how many balance sheets just don't balance. People don't know. They're not accountants, they're not bookkeepers, and they're just putting stuff into QuickBooks or whatever, and it doesn't really match or balance. But that's not going to be you, right? You're going to do it. So that easy $1,000 entry from the very beginning started, but it's going to get more complicated because every bit of activity you have in your business, whether you buy supplies, pay people, put gas in your delivery truck, buy inventory, sell inventory, write off bad debt, whatever. Every one of those financial transactions will impact the balance sheet, the income statement, and the cash flow statement at one time, right? So it matters. And once they get out of whack, it's hard to catch them. So it's really important that you have someone who is really conscientious doing these entries and know what they're doing. Understand your accounting software and be really cautious how you're doing that, because you want this to be as simple as possible for you. And you want to look at valuable data. Your balance sheet and your income statement and your cash flow statement are like that's your metrics to find out, is my business healthy? And if you have bad information going in, you're gonna get bad information to review to find out whether you're doing well or not. So that's it in a nutshell. That's the balance sheet. The next is the income statement or the profit and loss statement. Now, the profit and loss statement is primarily revenue, things you sell for your primary business. So let's use an example of a food truck. Whatever you sell, your hamburgers, hot dogs, tacos, whatever it is you're selling, that's your revenue. That's the sales number for your business. And then you have the next number. It's an expense. It's called cost of goods sold. And so then you have, okay, if you're making hamburgers, hot dogs, whatever, tacos, whatever it costs you, you go to the food service store, the people deliver the products. Gordon's is a big one, or Cisco's a big one. You go there and you buy that. Whatever that stuff costs you, that's the cost of the goods that you sold, which is an expense. Revenue, cost of goods sold. After that's going to be your gross profit. Now, some businesses, depending on your industry, if you're a service industry, you're not really selling a product, so to speak, the cost of goods sold might be in that. The labor might be in cost of goods sold. Mechanics, maybe like a cleaning company, that you're not really selling a product, you're selling a service. A lot of people will shove that number in there too, so you know where it's at. So profits is this number, and then you have your cost of goods sold, then you have gross profit. That's a number you want to keep track of. Obviously, you want your revenue to be as high as possible, but you want to be a profitable number. You can sell stuff at a discount and keep increasing sales, but never make money, which you don't want to do. But that gross profit number is also it's a metric. It's a real basic metric. Are you selling your product for enough? Are you getting good enough deals on the inventory or the labor, which you're doing it to make a good gross profit? And that's a number you should track on a regular basis, trend it year after year, quarter after quarter, right? And then the next spot on the income statement is the expenses. And this can be anything from your supplies, your utilities, gas for your car, for your delivery trucks, whatever. Many places will have their salaries in there, things of that nature. This is expensive doing the business every day. Your lease expense, your rent expense, whatever. So for every dollar you sell of anything you sell, product or service, you had to subtract out your cost of goods sold and your expenses. Then what's left over? Did you make money that year? And it's important to track this, because some people are afraid to ask for more money or raise their prices. But the truth is, if you have a good product or service, people are willing to pay for good quality stuff. And I know someone who ran a business for a long time. We had conversations about this, and I told this person one time, if you never have someone push back on your price, and this is like a manufacturing business, if you never have people push back on your price and try to negotiate it, you're charging way too little. Because there should be some kind, and it's not that you're trying to rip people off, but you have a lot going on in your business, and eventualities and all kinds of crazy stuff's happening. And if you offer somebody a price, that's $1,000 for that, and they're like, yeah, sure, let's do it. Well, either they're desperate, which should give you pause, or your price is way, way low. So you should have some negotiation there too. but you need to make enough money in your business. Now, is it because we're like greedy capitalist pigs? No, it's because stuff breaks. If you're a furniture store and you have delivery trucks, your trucks will need repair on a regular basis. They'll need to be replaced. You have to refresh your store on a regular basis, capital expenditures on a regular basis. If you're a restaurant, you have to continue replacing things, because I worked in a restaurant when I was a kid and I broke a lot of dishes, right? So they have to be replaced all the time. People want raises. If you're not able to pay people a good living wage or just a good solid wage and had promotion opportunities, they're going to bail and go someplace else, and it's more expensive to hire somebody new. So you want to have enough money to replace equipment that's breaking down, obsolete things, pay people well, improve their benefits, and put some money in your pocket, and then have enough there to absorb downturns. These things are all important, right? So, and that's in essence is the income statement. And the third thing is the cash flow statement. Now, the income statement usually is the favorite of most people because it's sales. Oh my gosh, sales are up. This is awesome. Oh my God, we're profitable, so profitable. But the cash flow statement is one that actually tracks the ins and outs, the movement of cash. And you really want to understand that cash is the most important. It's the lifeblood of your business. Having adequate cash in your business is super important, because businesses typically fail when they run out of money. They'll go as long as they can, but as soon as there's no more lifeblood, the cash flowing, it gets flatline and you get closed down, right? So you want to have your business as long as you want to have your business, not when someone else tells you your business is no longer a going concern, right? So have your business and do it well as you can. And these are things that you have to track. Now, there's three parts of the cash flow statement. There's the operating activities, there's the investing activities, and there's the financing activities. As a small business owner, side hustler, you're primarily going to live in the operating activities area. The operating activities section is going to start with the net income for the year, and they're going to make adjustments from there. And the adjustments from there are typically going to be the big ones for most places, or many places, are receivables and inventory. Those things are going to impact this thing much, and then depreciation as well. So inventory, or let's go back to receivables. Receivables actually use cash, which is kind of weird. Assets use cash. It's counterintuitive for a lot of people to understand this, but assets use cash. If you have 2 years of balance sheet together, and the first one is you have $10,000 in receivables in year X, and in year Y you have $15,000 in receivables, there's a $5,000 swing and an increase. Since assets use cash, 10 minus 15 is 5, negative 5. Your business burned through $5,000 in cash that year. So if you did 10 to 15, your receivables would have actually burned $5,000 in cash that year. Same as inventory. You want your inventory to be, again, slim as possible without losing a sale. So if you went $10,000 inventory one year, $15,000 the next year, 10 minus 15 is 5, negative 5. So now you have your business burned $5,000 in cash receivables, $5,000 for inventory, and your cash would have been lowered. We have some more adjustments to do, but in general, at the easiest high level area, it could have cost you $20,000 in cash. Now, do you need those things for sales? Yeah, receivables are important for sales. If you are like I said, you're a widget business and someone orders, they're going to ask you for terms, and you need to give them terms or turn the sale away. So you can make more sales by offering more terms. You also introduce more risk into the equation, right? So you want to make sure you're qualifying your people to pay you on time, and you're holding them accountable to pay as you say. Now, you give 30-day terms. When should you call them when it's not paid? I would suggest, if it's the very first time you've done business with this customer, you've did some qualification, you think they're a decent risk, day 31, payment's not made, it's showing past due in your accounting software, I would say pick up the phone and call them and say, hey, this is John from John's Widgets. Just want to make sure that you received the shipment that we sent to you such a time ago. Yeah, we received it. Was everything okay? Is it everything operational, nothing broken? It's all fine. Okay, well, I'm just kind of wondering because the terms were 30 days and it's day 31, we're not paid. Now, they might be a little bit grumpy with you. But what you're doing is you're setting an expectation of payment on time. That, see, every day they don't pay you is it costs you money. and every day they don't pay you, they make money, because it goes two ways. Payables is just the opposite of receivables. If they can drag you out, not pay you by a couple days, they actually have a better cash system, and it's unethical. It's not good. Some people are just sloppy, and that's okay. You can learn that. But you need to hold people accountable. At what point do you let them go farther? I would say if you're doing that and they're paying you at 45 or 50 days on a regular basis, then you renegotiate the terms and you pad some money in there, because you're giving them a deal on the stuff with the expectation to pay in 30 days. If they're not, then you need to adjust your pricing accordingly, because you're taking on the risk for this, not them, right? Inventory is the same way, right? So have your inventory as thin as possible, but without losing a sale. These are arts, not sciences. There's disruptions in supply chain for inventory, but what you want to do is make sure you have that stuff in place, because that's going to impact your cash flow, right? So there's always somebody trying to sell you something. Say you're a furniture store, and there's your vendors are going to try to sell you something, but you're like, I don't need that stuff. So make sure you need it and make sure you can sell it. And whenever you get a point where it's something that's out of season or obsolete, get rid of it, discount it, sell it. You're going to take a loss on that piece, but it's not going to cost you money in other areas, right? So again, these are areas you will learn as you go in your business or side hustle, but it's important just to have a really high level view of it. Now, investing activities may seem, the term can be misleading, because it's not like you're putting money in a 401k or a IRA. It's more like you're investing in your business. So, and you will do that eventually. I would say I would recommend you steer clear from loans. If you're a small business owner or a side hustler, I'm talking about small, like solopreneur thing. You don't really take a lot of loans out until you start hiring people and things get a little bit, and then you need to do a real good mathematical verification that this actually is going to work for you and not just something you want to take on arbitrarily. Make sure the math makes sense. Make sure you've done your homework and you understand this. But you don't want to get a bunch of loans for things you don't really need. Until you absolutely have to have it, I would say go without it, and keep money in the business as much as possible. And then so that's going to be investing in your business. And financing activities, like if you're paying dividends or issuing debt, which as a small business owner or a side hustler, depending, if you're a corporation, you might issue dividends. You might do that, right? So that's very possible. But for most of us are going to live in the operating activity area. So let's go back to the balance sheet again. So we had the balance sheet as these things all work together. So your cash flow statement at the end, because you're going to take your operating activities number, hopefully net operating activities is a positive number, and often like investing activities and financing activities are negative numbers. So you have a positive number for operating activities, hopefully, negative for the other two. They're going to all subtract from each other. So operating minus investing minus financing, what you want is a positive number, because that number is actually going to go back to your balance sheet, and that's going to change your actual cash number. So you want your operating activities to generate enough positive cash that it can absorb any kind of investment and any kind of financing that you might need. And then another thing too, back on the balance sheet, because the income statement at the end of the year, let's say you made $10,000. What are you going to do with that $10,000? You can do a lot of things with that $10,000. You can pay dividends out. You can give it to the owner, or you can do a hybrid and pay some dividends and retain some dividends. So at the balance sheet in the equity section, you have the common stock, usually it is common stock, which is your initial investment in the company. And then you have retained earnings. Retained earnings, all it is profits that are not distributed. So if you made $10,000 and you distributed $5,000 of it, $5,000 stayed in there. So in our initial example, you put $1,000 in the bank, your common stock was $1,000, and you made $10,000 that whole year. You kept $5,000, you paid out $5,000. Then now the equity section of your balance sheet should be $6,000. And companies that have been around for a long time, they can grow that retained earnings bucket. And it's not a secret cash reserve somewhere in the back room of the business. It's a liability. It's something your business owes you as the owner or the side hustler of this business. So one day when you're saying, what is the book net worth of my company? Going back to the beginning, ask you, did you know what your value of your company? The book net worth of your company is your assets minus your liabilities. And that's whatever's left over. That's kind of what your company's worth. Now, some people might say we can go into the net income statement and we can do earnings People will do earnings before interest, taxes, depreciation, amortization, total separate subject, and I don't want to get confusing. But they may take that number, which is a cash flow number. This is the cash that the business is supposedly generating. I'm going to pay for the future earnings of that. So they may, if you're selling your business, they may do a multiple of what they call EBITDA, earnings before interest, taxes, depreciation, amortization. Say if it's $10,000, the multiple say 5. 10,000 times 5, then they could say your business is valued at $50,000, or you can see the book net worth, the book value of the business is the assets minus liabilities, whatever's in the equity. That could be just a ballpark, back of the envelope, what your business is worth. So every year, check your balance. I would say do this quarterly at least, all these quarterly, and then find out what works best for your industry. If you have a clothing store, inventory turns will be much faster than if you own like a boat store. Right? If you're building things that take a long time and you sell it, it's going to be a lot slower, right? So everything's different. Restaurants are different than plumbers, and plumbers are different than McDonald's, and coffee shops are different than, a tour agency. So find out what's best for your industry, and then start looking at take your balance sheet, your income statement, your cash flow statement, and find some ratios and trends and track them to find out the health of your company. If you go to the doctor's office, the first thing they're going to do is weigh you. I know, I hate it too. They're going to weigh you, and they're going to take your blood pressure, take your temperature, the real basic things to find out, is this dude in decent health? You should do the same thing with your business. So you should know what your cash position is, if you're generating positive cash, what the value of your company is, what is your debt to equity, what is, there's a lot of different ratios you can use. I don't want to throw out too many because then people might focus on that one, because every industry is different. But then if things aren't going well, then you can find out where is the leakage in this, what do we need to shore up? Is our cash dwindling? Our receivables terms are 30, but they're paying us in 60. Maybe you need to invest in someone who can call and not be ashamed to call and ask for money. Or maybe your payables is costing you cash. Well, payables is a liability. And liabilities are a source of cash. Counterintuitive, I know. But if all of a sudden your payables person is like, I'm going to do great things, and I'm going to be super nice to everybody, and the terms are 30 days, and they're paying it in 10 days, they're paying it 20 days fast and getting zero incentive for it, and zero benefit for it, it can actually be a leakage of cash in your business. So you want to pay your payables at the terms, not way before, not after, and you want to collect as soon as you possibly can, and you want to keep your inventory on track so you're not having inventory in your warehouse or on your showroom floor and the whatever. If you're a bookstore, dust collecting and then people never want it. It's unique. It's an art, right? It's an art form, but you want to make sure your business is operating in an efficient, effective, profitable way. All right. Hope this has been a blessing to you. The book, the Next Level book, has a ton of information in this. If you are interested in more of this, you can Google income statement, cash flow statement, balance sheet. There's a ton of stuff out there. I like Investopedia. I do some stuff from Harvard Business Review that's good too. Really basic stuff, and find out what it is. And I would encourage you not to shy away from your balance sheet, income statement, cash flow statement. Become friends with an accountant or a bookkeeper. Let them coach you, believe them, and then you can actually make decisions based on facts and not like your gut feeling. Every small business owners have this great intuition, but you need to actually learn with facts and lean with facts a lot of times, because sometimes you can make these big plays that the fundamentals do not support, and next thing you know, you're gonna find yourself out of business. So trust your information, use it as a guideline, and work through it that way, and improve your business. As long as you do this and you put good controls in place and work through it, then you will be profitable. And I dare you to profit, so that you can practice and promote radical, revolutionary generosity. I'll see you soon with another video. Until then, blessings.